Welcome once again. Today we will discuss financial derivatives and portfolio management. These two topics are very important, under which we will learn derivatives, different kinds of derivatives, how derivatives used in the markets. Then we will learn portfolio management, under which we will learn two methods, how we can plan our portfolios, and what are the ways that we can plan our portfolios. So this will be the table of contents for our today's presentation. But start with derivatives. Okay, most of the times we think about how we plan for the future. So the term derivative refers to a type of financial contract whose value is dependent on an underlying assets, a group of asset, or a benchmark. Okay, so normally this context can be used to trade any number of assets which come for with their own risk, and the price of derivatives it is based on fluctuations in the price of underlying assets. So that means what we are trying to do is we try to go for the we are thinking for the future, how well you can plan your future. And if we talk about derivatives, we talk about hedging against risk seekers opportunities. There are mitigating risks, assuming that risk will be there in the nearest future. So a derivative is a complex financial security that is a set between two or more parties. So it is been formed with a two or more parties which derives any values for the future. So most of the time, two persons, those who are buyer and seller, they try to make an financial instrument, try to use this instrument so that they can have the maximum possible option how they can derive the future. And this it is based on your underlying assets. So we try to avoid the risk that we will be having in the future. So there are four instruments on the base of which you can plan your way of buying and selling of an asset. And we are thinking for the future. So what will happen in future? So that is how the derivatives are very important. So when we talk about what are the types of derivatives and why it is required and why we have to think on how we can deal with the derivatives. So there are four kinds of derivatives: future, forward, swap, and option. Here, two parties will be there, and two parties will accompany how they can plan their derivatives for the future. Like if I talk about the first type, which is future contract. Okay, so we have already learned the risk management also. So a future contract is a standardized forward contract where buyer and seller are bought together at an exchange. The buyer is obliged to purchase the underlying asset at set price in the date. Okay, so most of the time when we talk about why it is required to have a future contract, so we talk about for the future, how future lies. Okay, so it is an agreement between two parties for the purchase and delivery of an asset at an agreed upon price at a future date. So the price is already been set, and a future are standardized contract which is based on the trade exchanges. Likewise, if I give you an example, like on the November 16, a company buys $100 contract for the future in the month of December. Likewise, if he is thinking, the company is thinking that that price will go on the set price. So on the given date, like if the date is 19th December 2024, so both party will oblige to go for providing like 100 barrels of oil, and they will pay $100 per one barrel, multiply by 100, so they will pay the price. So we are setting a price for the future, and same way the settlement will be taken on the same day only. So what we are trying to do is we try to have the maximum possible outcomes for the future so that we can have the benefit of the future. And that is why it is important. So we are setting a price for the future, knowing that this risk will occur. So here buyer and seller, both parties will know that future will be uncertain, and they will fall the risk of not getting the corrected amount. If we talk about forward contract, so a forward contract is a contract where a buyer agrees to purchase the underlying asset from the seller at a specific price on a specific date. Okay, so but it is like a future contract, but there is no prescribed format. In a forward contracts, both the parties, what they do, it is a customizable contract, and it can be tailored to a specific commodity amount and date. So when we talk about forward contract, we know that this happens. So we try to avoid the counterparty risk which are already associated, and we try to go for the where how the parties may fall to deliver the obligations. What will happen if this party is not getting, one party is providing a product, one party is not providing the product. So what they are trying to do, it is just the buyer and seller can customize the terms conditions, they can customize the size also, they can customize the settlement process also. So it is a great degree of a counterparty risk. We try to apply that what will happen in future, it will remain with us, and we try to get the maximum possible outcome with the options available with that. So most of the time, why we are dealing with this kind of opportunities, because we know whenever we plan for to buy any assets, we know that future is uncertain, and there are high number of chances that people will either buy or they may or may not buy this particular product. So we try to go for the counterparty risk. And how we can say, so there are counterparty risk or credit risk, where the parties involved may fail to deliver the obligations on the given date. So what they do, one party becomes insolvent, so other party have no recourse and could lose the value of its position. So here in a forward contract, we try to go for a counterparty risk, we try to avoid this risk, and the parties in a forward contract can be offset their position with the counterparties. So what happens here, both the parties can edit or can think about how the options will get changed. So any tailored document will be done, and depending upon market's requirement, they can prepare or they can go for the forward contract, which is most popular in India. Future and forward contract are most popular in India because we try to set a price for the future, and same way we are trying to get the maximum benefit out of what we are getting. So these are the two basic contract. The third one, if we talk about, so which is an option contract. Okay, so most of the time when we know that how we plan for the future, so an option contract is a similar to a future contract, and it is an agreement between two parties to buy or sell an asset at a predetermined future date for a specific or a specified price. Here, the key difference between option and future is that an option, the buyer is not obliged to exercise their agreement to buy or sell. So it is an opportunity only, so not an obligation as futures are. Options may be used to hedge or speculate on the prices of the underlying assets. So when we know that, like if we are buying any assets, we are planning to go for an asset, so it gives you an option. Who get the option? Buyer will get the option, and there will be no obligations. So here the buyer and the seller are obliged to make transaction on the specific date, whereas with the options, the buyer has the choice to execute their option and buy the asset at a specific price. So here we are giving an option, like if buyer has an higher option that they can select for the particular point of time. So what they are trying to do, they try to go for the this particular option. And why they are selecting option contract? Because they know most of the time buyer has an additional inputs, or buyer has an additional output that they can plan how they can go for the market. Likewise, if we have to take an example, imagine an investor owns 100 shares of a stock company and having 50 rupees per share, and they believe in the future the prices will go. Okay, so what they try to do, they try to take an option and they are locking price at 50%, which is called as a strike price. And there is a specific timeline, which is expiration date, where they will the cost for option is 2 per share. That means if 50 rupees per share is there, 2 per share is the option cost. So that means they will get 48 per share in future. Okay, and so what happens in future? Suppose the price of a share decrease to 40 rupees, that means the total loss is 10 rupees, but the buyer has taken an option contract at a 50 rupees as a strike price of 2 rupees per share. So in total, instead of 1,000 rupees loss, he or she will only have 200 rupees loss, and it can be a huge margin. So we can go for an option like what will happen in future, and here the seller are obliged to fulfill the side of the contract. So most of the time seller knows how they can plan, and they know at what specific date they want to provide this particular option, and how they will give this option. So this is an option contract. Name itself suggests they are giving an option to a buyer. At any point of time they can buy this particular option, and we can plan how well we can see the future is incoming, and we can plan how the option contract is more suitable for the future. So the fourth and the last one is swap contract. Okay, so a swap is an agreement to exchange future cash flow. Here we talk about future cash flows, and typically if we can say, so one cash flow is variable while the other is fixed. So what happens here, if you are going for a swap option, name itself suggest they are giving you a swap option. Most of the time, they gives you an exchange option in exchange of your quantity. Like if you are having a share, a trader has an interest rate swap. Okay, so in future what happens, imagine and Alicord Limited has a 1,000 borrower capital which is variable rate in market, which is 6%. Suppose market getting relent and interest price goes up, so okay, that goes to 8%. Okay, instead of 6 it goes to 8%. If the seller has taken a swap contract up to 6%, so what happened in future, if the price goes up they only have to pay the difference of the price, which is swap contract. Okay, and same way if the interest rate falls, so they have to pay the minimum rate regardless of how the party goes on. So the swap contract can also be considered to exchange currency risk or the risk of default on a loan, or we can say cash flows from another business activities. Swaps related to the cash flows and potential defaults of mortgage bonds also can be used as an extreme popular derivative. In fact, both the options are very much useful when we know there is a credit crisis. So the swap option are more relatively useful when we are thinking about how well we can plan these particular options. What are the opportunities that we have? This can be fixed, or we can say how we can plan for the swapping option. So most of the time these four instruments they are planning to go for the futures, how well you executed the current model. And we, if we talk about what options we have, so we have future contract, we have forward contract, we have option contract, we have swap contract. So derivative they try to give you an underlying assets, how well we can plan our future, why it is needed, what are the key takeaways, why we have to go for this. And most of the time, so as we all know, like traders have their market differences, and then they know the stock, bonds, commodities, currencies, interest rates, market indices. It will either it will go and up, like it will get changed day by day. So we know that there is a primary instrument is ongoing, and so derivatives, why we have to use it. So derivatives can be used to hedge, speculate on the directional movement of an underlying asset, or a leverage option. Okay, so these assets are commonly traded on an exchange counter trade, so that we can go for an try to avoid the hedge in the market, try to avoid the speculation in the market, try to avoid the defaulter risk in the market, try to avoid what are the consequences that we face. We try to risk managing, we try to leveraging the position, we try to overtake the speculation, we try to overcome the risk tolerance. So these are the options available. So when you are actually in the market, you know how market gets changed. So we try to plan our future with the help of these derivatives, and that is why it is equally very important. And if we can sum up how these derivatives comes and how we have to plan our derivatives so that we get the maximum outputs. So it is like derivatives are financial instrument those value is derived from an underlying assets. So which are their assets? Which are stocks, bonds, and or commodities. Okay, so these are the three instruments we are making bet on this. Then why we are planning derivatives? So they are used to for the hedging risk, speculating on a price movements, or leveraging investment in the financial market. So we know there is a hedging risk, there is a speculation risk, and we try to avoid that risk. What are the types of derivatives are there? So we have already discussed futures, swap, option, forward contracts. Okay, depending upon the purpose. So we know our purpose of going for this particular option, and we try to take those opportunities you will get from the outputs. Same way, when we talk about the value of a derivatives is influenced by the price movements of its underlying assets. Okay, so it's a complex financial tools. So when we know there is a problem in the speculations, okay, so we have to keep on thinking how well we can plan our options. And if we talk about why it is required, why we need to understand this topic, because to understand the notional value of derivatives, underlying assets, and market conditions of the affecting price. So we know that sooner or later there will be a change in the market, and how this change will affect. So there are certain circumstances, and we have to look forward how these circumstances either way help you, or it may go against you. And if it is going against you, then we have to plan how well we can tackle. Most of the times when we are tackling these such situations, we have to go for the derivatives option. And that is how we can find how in 2030 what is the role of derivatives. So what it actually is doing, identifying the key players in the derivative trading essentials, and which helps hedgers, speculators, and arbitrators to look into this risk. And it will either directly help, and here you can also assess the risk. What are the risks? So derivatives trading carries inherent risks such as market risk, credit risk, liquidity risk, and depending how we can approach. So there are strategic approach also required. So approaches for hedging, speculation, diversification, and right approach should be used to get the maximum derivatives option. So most of the time when you use derivative option, there are high number of chances that it may either affect, it may either usable form, and most of the time it is useful for the future also. So when we talk about how well we can plan, what are the ways we think to go for these derivatives. So it is already required. When we talk about how we can take decision making, so educated traders can navigate the complex world of derivatives with the synchronizing knowledge of rules. So that way we can derive, or we can talk about derivatives for the futuristic approach. So when you actually know how derivatives work, so that way you can plan for the future, and most of the time you can have the maximum option for the derivatives. Next is portfolio management. Okay, so how we can manage your portfolio? What are the ways? So first is modern portfolio theory. Second is capital asset pricing theory. Okay, so these are the two ways you can manage your portfolios. Now, how well or why it is required? Why you have to always think for the portfolio management? So, what are the options we have to take? So, we have to understand what is investment risk, then what is, we have to understand modern portfolio theory, why it is required, and we have to understand capital asset pricing model and how it is different from one another. So when we talk about what is investment risk, so actually the investment risk means the probability of losing some or all of your investment. That means in future there might be chances that some of your investment may you will get lose by that. So we have to plan that how we can see in the future, and we can have the maximum possible outcome with the risk. What is the risk function which is possible? With that we can have expected value, and with that we can measure the risk, how well you can plan your future. And most of the time when you actually know investment risk are more usable, you have to think about what is maximum possible outcome available for us. So that is why model portfolio theory is required. Here you can see the formula. We talk always about the expected return of a portfolio is weighted average of expected return of returns of each of the securities in the portfolio. So most of the time, this particular option, the modern portfolio theory argues that an given investment risk and return characteristics should not be viewed alone, but should be evaluated by how it affects the overall portfolio risk and return. That is way an investor can construct a portfolio of a multiple asset that will result in greater returns without a higher level of risk. Okay, it is like it is an alternative starting with a desired level of expected return, and the investor can construct a portfolio with the lowest possible risk that is capable of producing that return. So what they are actually try to give you an actual option how well you can plan your future, and it is purely based on statistical methods because it is based on accepted risk. It is based on how you looking for negative correlation, whether this is related to your theory or not, how well there are circumstances get changed, what are the equal circumstances that happens for the future, whether your portfolio gives you higher return, what is your expected rate of return, what is your portfolio is ongoing, whether you are taking the correct portfolio or not, whether how well you can plan your investment so that in a taking lower risk you can get the higher return. So that is this modern portfolio theory, and it is based on how well you can plan your future. Most of the time when we talk about how I should plan my future, so we have to always think the riskiness of a portfolio is more complex. So we have to always think what are the risks, and that we can calculate with the help of formula where we can find the correlation, then we can find the average correlation, and we try to get the average security pricing which gives you a negative impact. So what we try to do, we try to go for this particular theory. Why? So this modern portfolio is a practical method for selecting investment in order to maximize their overall returns with an acceptable level of risk. Like it is a mathematical framework, it is used to build a portfolio of investment that maximize the amount of expected return for a collective given level of risk, so that we know that what risk is required, why I have to take this certain risk, why it is directly important, why we have to always think for the future, why it is required, what are the circumstances are there, whether this theory gives me the level of perfection, whether there are certain alternatives also there. Okay, so what it is trying to do, it gives you a better options from the market using the same investment options, but investing in a right time and disinvesting at the right time. So this modern portfolio theory is very important when we talk about what are the efficient portfolios. Okay, so there are certain options available where we can see that these particular portfolios can be used when it is required. So how we can draw a conclusion? So when you use modern portfolio theory, most of the time you can rank your investment options with the help of this theory, and you will see the difficult what are the different circumstances can be happen for the future, how it is different from one another, how you can break your options. Okay, so the this theory it can be used to diversify a portfolio in order to get a better return overall without bigger risk. So here we try to avoid risk or taking minimum risk and getting maximum diversification, maximum outputs, maximum efficiency, and it is used with the help of diversification option, and it can reduce volatility in the market. Okay, and most of the time when you are actually using trade on anywhere anytime, and you can have the maximum possible outcome of your given return. So we try to go for the risk reduction, and why it is required. So risk reduction, why we have to take less risk compared to other. So taking lower risk requires diversification. Okay, so once you go for the diversification option, it gives you a lower risk option, and same way the correlation of your coefficient will also go up, and that way your security prices will always go on. This way the number of security or the portfolio increase the portfolio risk and decrease is the approach. Same way if we can see the market, most of the time the market risk is inherent from business cycle, inflation, interest rate, economic factors. This will directly affect, and we try to avoid this with the help of using the risk environment. Same way when we talk about specific risk, or we talk about liberal option, we go for the new product development, company related issues, other existing factors, how these factors can be affected for me on my portfolio option. So that is how you can use this particular theory. And there are some other options, like you can try to go for mathematical options. Okay, so increasing the number of stock reduces the portfolio risk. So number, you try to go for the more basic units. So that way you know that your investment portfolio will go, and that way there are a high number of chances that once you start investing, there are n number of options available where you can plan your mathematical options. Then you go for the diversification across times. So you try to diversify your portfolio with the time management. You go for dollar cost averaging. So you go for exchange rate option like swap option you are taking. You try to have a naive diversification, like go for buying random options, purchase equalize options. Okay, you go for the any other specific options where you get the maximum benefits. So you try to use diversification in case of taking this particular value. So most of the time when we talk about how you can plan, so you can use this modern portfolio theory, and that way you can plan the possible best outcome for the future. Now when we talk about capital asset pricing model, we always talk about capital asset pricing model. Why and how we can find this? So the CAPM model, it assumes two assets, the risk-free asset and the risky market portfolio asset. So that means we know that there is in future like these two assets can be directly affected. And we talk about CAPM model, it describes the relationship between systematic risk or in general perils of investing and expected return for assets for a particular stock. So it is a finance model that establishes a linear relationship between the required rate on an investment and risk. So what it try to do, so CAPM is based on the relationship between an asset's beta and risk free rate and equity risk premium, or the expected rate on the market minus risk free rate. So what it try to do, it try to gives you a bigger picture how well you can give the priority of the option. Most of the time when you are actually investing for the longer time, there are high number of chances that your investment value will go on and you get the maximum output also. So this theory either directly affects you, either indirectly affects you, because you are trying to go for the cost of capital, and you try to minimize the cost of capital, and you try to go for the standard deviation of the risk free as a assets as a zero. So most of the time when you actually use CAPM model, you try to go for the two option theory where you know how well you can go. So what are the assumptions CAPM model takes? So investor have a cost free and equal access to information leading to homogeneous expectation. Okay, so every investor or every option that you are taking, there is a homogeneous expectation for the investment outcomes. Here no transaction cost or taxes will be there, so it is perfect condition where you try to go for the investment. Here security in fact divisible, that means your securities are divisible and it can be divided, like if you have more than one option you can go for. Investments are rational and seek to maximize their expected utility function. So here investments are thinking for maximum possible outcome, like how I am investing, what are the period I'm investing, and all investment is for the same time period. Okay, so there is timeline is not changed, like you are looking for the same time where you are investing. Okay, and all investor can borrow or lend at the risk free rate. So they know they can borrow or lend the money, and they can plan their portfolio. When we talk about capital market line, we talk about expected portfolio return where wealth is invested. When we talk about portfolio risk, where there is a alpha and beta position is there. So most of the time, when you actually know how well you can plan your capital risk, and you have to think what are the options available for you. So capital asset pricing model and beta is there. So beta compares the security or portfolio's volatility or symmetry risk to the market. Like if a stock is riskier than the market, it will have a beta greater than 1. If a stock has a beta less than 1, okay, the formula assumes that it will reduce the risk of a portfolio. Okay, so it is less than 1, that shows it is lower risk. If it is more than 1, there is a higher risk. Okay, so there is a premium rate and discount rate will be applied. And most of the time when you are an investor, you try to maximize the realistic option. And but there are unrealistic assumptions also there, like securities market are very competitive and efficient. Like you cannot based on one information how well you are planning, why it is required, why you are thinking this particular option is multiple used, what is theory is that you are thinking for a risk premium, you go for the efficient frontier, like you are trying to go for the inferior or maximum options available for your options. So most of the time when you know, like you go for an expected risk with the expected return. So most of the time when you actually know that your investment are very liable, then you have to go for certain combination which gives you a standard deviation with the assets. And most of the time you can plan how well how your holdings can be more risk free, and it can be diversified with the help of market portfolio. So most of the time you try to go for the borrower lending line, and it divides your options, and it gives you more suitable options for the future. But they are taking certain expectations also, they are taking certain assumptions also. So that way you can plan how this market value goes. Here we try to measure the relative risk, we try to measure the relative risk with the security also, and it shows how well it is planned in the market, and how well you can plan your portfolio so that you get the maximum output from the given inputs. So you are trying to go for the available inputs so that you get the maximum option. In a CAPM risk model, you try to go for the systematic or non-diversifiable risk, where beta is measured by the systematic risk. So you can have any of the options available here, and you go for the risk due to firm specific attributes. You can select irrelevant options also, you can select decision making options also. So you try to use this particular line so that you can use this model for practical methods also. Because there are certain assumptions that they have taken, like all investors are risk averse by nature. Okay, so they don't want risk. Okay, investors have the same time period to evaluate information. Like if there are two or three investors, so they are thinking that two or three investors are investing at the same time. There is unlimited capital to be borrowed at the risk-free rate of return. So they are assuming that whatever investors are, they can go for they can borrow any rate on the risk-free returns, and investments can be divided into unlimited pieces and sizes. So they know they can like any options they can go, like they can hold 100 shares from 100 companies, which is actually undisputed option. Okay, it gives you more disputed option. It shows there are no taxes, inflation or transaction cost. You know there are taxes, there are inflation, and there will be a transaction cost. Okay, and they are also assuming risk and return are linearly related. Okay, so they are linear, they are going on the same line. So whether we are going whether we are selecting the correct alternative, why we are selecting this particular line, because the CAPM uses the principle of modern portfolio theory to determine if a security is fairly valued. It relies on the assumptions about investors' behaviors also, risk and return distribution also. They go for the market fundamentals, which actually don't relate. So they try to give you a more realistic option as compared to some other methods also, and that gives you a maximum possible outcome. because it gives a mathematical a model which actually estimates the expected return on investment based on its riskiness related to the rest of the market. So they try to avoid the risk. They try to take conditions linear for everyone. So each and every investor are simple, because what percentage of amount you are investing, that is very important here. What will be your base of amount, how well you can plan, how well you can be planning your investment, whether these particular options are more usable or not, whether you are planning the correct rate of return or not, how you can estimate the risk premium, because like the market for used to find the risk premium also, which is theoretically imperfect, but there is a problem in the market also. Then the CAPM model in the efficient frontier, like how they are winning in the market, because there are ideal market portfolio, efficient frontiers, capital market line, inferior portfolios, individual assets. That shows expected return and expected risk can change by the way they are thinking. So most of the time, when we see how well we are planning, or how well we are planning our portfolio management, it gives you a maximum possible outcome. And that is how we can sum up the security market line also. It addresses the risk return characteristics for individual securities, and it gives you a beta's coefficient. So we know that these conditions it may change. Then we have to select the correct possible outcome out of this. So today we have learned about financial derivatives, and we have learned about portfolio management under modern portfolio theory and CAPM approach we have taken. Thank you for listening.